All right. Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. We'll get started here in just a moment. I'll just go live on all the different platforms. Go ahead and drop a comment there in the chat. We got the chat up on the screen. We will get started in just a moment. Appreciate everybody tuning in nice and early. All right. So it looks like we're live on all the different platforms. We'll go ahead and get started. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat and drop any questions you have in the chat as well. All right, so welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through a new loan officer training topic. And tonight we're going to be talking about something very basic but very important, which is how to properly complete a purchase pre-approval. So Jose's been doing purchase pre-approvals for 28 years. I'll let him take over and let's get into it.
Good evening, everybody. Thank you for joining us for tonight's training. Tonight's training is going back to the basics, but always in times of increased activity and volatility, it is always a strong recommendation to get back to the basics. Make sure you're covering all your bases, dotting all of your I's, crossing all of your T's, and as always, being the ultimate loan consultant, which is what we strive to be at the Mortgage Calculator. So tonight's training is on how to properly complete a purchase pre-approval. So we're adding a couple of interesting twists to this, as I always like to do, so that we can always add value to the transaction and ensure that everybody's expectations are exceeded and you receive many referrals and have a sustainable MLO career. So let's jump right into how to properly complete a purchase pre-approval. So let's define a little bit what we mean by a pre-approval, right? A pre-approval for a real estate loan is a preliminary evaluation of a potential borrower to determine which program options they qualify. Now, you know how we do our pre-approvals here are very thorough, right? As you can see there in the bottom in red, it is not a pre-qualification, but a credit and income approval. The purchase pre-approval is the first step on the path to home ownerships. Now, be aware of certain critical points here. First, very important point to consider regarding purchase pre-approvals is that listing agents generally require that any offer to be submitted on a property that they're going to receive, be accompanied by a loan pre-approval. If your offer is not accompanied by a pre-approval, there's a good probability that it is not going to be reviewed. It is just going to sit there until the pre-approval is received, right? What good is it to have a gun if you don't have any bullets? I mean, the pre-approval is that important in this whole process. Now, also note the following. To be able to present the offer, you have to be able to look at properties, right? And buyer's agents, at least good and successful buyer's agents, generally require a buyer be pre-approved before showing any properties to that buyer. You're not going to go show somebody, say, hey, show me some homes, 3-bedroom, 2-bath, in such and such neighborhood, and you go and you show them properties, and then lo and behold, they don't have any money. They thought they could, they heard how these things could be done, but they have no idea. But they didn't realize it wasn't going to be possible with their 500 credit score, right? So, just obviously that's an extreme example, but we want to prevent that for all parties involved, right? Why create unrealistic expectations for your borrower, right? All of our expectations have to be based in reality. and that has to be assisted by the loan consultant from the mortgage calculator. Pre-approvals also allow for budgeting and financial planning, right? How are you going to know how much you need to save, or if you have enough, or if you're going to be able to, even though technically you qualify, if you're going to be able to live. So again, the pre-approval, detailed one, very important. And also, being pre-approved allows for a more focused and efficient process. And this is key because this results in higher success and satisfaction for all involved parties, right? The buyer slash borrower, our borrower in this case, um, the seller, the real estate agent, title company, insurance agents, right? They're gonna say, "Wow, Jose, he's the next best thing to sliced bread," and they're gonna send referrals. Matter of fact, I just received a referral today from Texas on a deal where I did not get the deal. Eventually, I did not get to close the deal because the borrower came to me after he had already applied with somebody else, submitted, almost ready to close. Then they decided they wanted to close in an LLC, and the other company couldn't get it. We didn't close it because they didn't give him the extension, but I did such a thorough job in getting it ready to close. Should in my communication with his real estate agent at the developer and with the borrower and with the title company and everybody involved, they were so impressed with how I handled that scenario compared to how the other company was handling the scenario, that they referred me today a deal and not that other company that gave them a big headache. So that's the kind of stuff that we're talking about the sustainable MLO career, steady stream of referrals. That's what you're going to get if you exceed everybody's expectations. That's the end result: steady stream of referrals and a sustainable MLO career. So you could see how getting off on the correct trajectory and following the correct steps in the process is a win-win-win situation for all involved parties, especially you as the MLO, right? Increased profits, right? Less waste of time, less more efficient operation. All the things that we're mentioning about that is basically music to everybody's ears. So again, the pre-approval, remember, is not a pre-qualification. Pre-qualifications really are worth the ink on the paper that is written on. That's about it. A pre-qualification is essentially maybe that first initial conversation you have with them, very brief. Yeah, I think that can be done. Now let's do the actual pre-approval, right? This is where you review credit, income. If there's already a property, you review the property, always striving to be the ultimate loan consultant so you can build credibility and gain trust. That's very important in this industry where the borrower is probably going to be completing the largest financial transaction of their life. So you can rest assured that credibility and trust are going to be just as important as the interest rate and other factors associated with the interest rate. So you can see how the pre-approval is such an important tool. So let's break it down into what we would be doing, right? First, maybe it's going to be an agency pre-approval. Well, what are the considerations to note if it's going to be an agency pre-approval? Well, remember this: agency loans. And when I'm talking about agency, we are talking about conventional loans, Fannie and Freddie. We're talking about FHA loans. We're talking about USDA loans, and we're talking about VA loans. Now, all those loan types, besides each having homogeneous guidelines, like we just discussed in our guidelines training recently, they are all always full doc. No alt doc on its own, on agency. We do have some limited instances where we can combine asset utilization on a full doc loan on an older individual, I believe 62 and older, to supplement their income, their fixed income or W-2 income, salaried, hourly, whatever income, retirement income, whatever income they may have, and we can supplement that with asset utilization. But other than that, that's still going to be a type of full doc. But other than that, there's no other alt doc type in agency. So now the other consideration, if it's going to be agency, obviously, if it's investment property, your borrower is not closing in an LLC, right? Because if they want to close in an LLC, that's non-QM only. But here now, is your deal going to be AUS, automated underwriting, or is it going to be manual underwriting? Now, obviously, you won't know until you run it through AUS and see if you can't get the approved eligible. You may know if you're starting with a 500 credit score FHA borrower that it may end up being manual underwrite, but you don't know until you set up the file and submit it. I just had a meeting today with one of the MLOs. We're going over file structure, 2 separate agency loans, and both discussions ended up with, well, but have you submitted it yet to AUS to see if you're going to get a 1-year finding or a 2-year finding for the income? Because if you get the 1-year finding for the income, you're going to eliminate all of the issues that you're having because you're only going to be dealing with the current year as opposed to 2-year findings, right? So again, AUS or manual underwrite. If it's AUS, you're talking about DU, which is Fannie Mae's automated underwriting system, or you're talking about LP, which is Freddie Mac's automated underwriting system. You need to receive an approve eligible from DU or an accept from LP in order to be able to issue a pre-approval letter. Again, we're going back to this is not a pre-qualification. There's no such thing as a pre-qualification letter. I mean, I don't know. Again, that's worth the paper and the ink that it's written on. The pre-approval, if it's, for example, the agency pre-approval, you're gonna require the AUS approval. And in order to get an AUS approval, you need to set up a complete loan application. You need to review your credit docs, income docs, asset docs, property docs. If there's a property, if it's a cash out or maybe a purchase, TBD, but you have some information, right? Review, input the data into the system. Typically, we're going to be doing this as a TBD pre-approval initially, unless it's a submitted application already, triggered application. And then you're going to see if you get the approval that you need. Only then, after reviewing all of this stuff, remember, this is not on hearsay that's provided by the borrower, information. Normally this is that you reviewed documentation, verified it by your review, and then that's once the file gets submitted to underwriting, it's going to be verified by the underwriter, and then you get your loan commitment. So again, to issue pre-approval letter, AUS approval or accept. Remember that in AUS, any credit score, trade line requirements are determined by AUS, determined by automated underwriting, right? You don't know if on an FHA approval, you're going to get the approval at 56.9% max, or if you're going to only get an approval up to 53%, because the system, the algorithm is going to review, assess the risk, and then either issue or not issue the approval that you're looking for. So anything having to deal with trade lines, any of that stuff, credit score is only going to matter. Obviously, you want to look at it to see if you fall within the basic matrix for a manual underwrite, but then you're going to submit and maybe be surprised. I've had on a conventional loan with 20% down, I've had a borrower with 1 open trade line and 1 closed trade line, with a co-borrower with 2 open trade lines and 1 closed trade line get approval because they both had high credit scores, 20% down. They both had substantial reserves. The system loved it, approved it, right? So again, don't get too hung up on the minutia until you actually submit to automated underwriting. You're, something that it should be 100% representation of the documentation that you reviewed, and see if you get your approve eligible for DU or you accept for LP. Now, when you are considering credit for this agency loan, be aware of a couple of items here that throw people off. The first is disputed accounts. Now, this happened to be the topic of the session I had today with the MLO, where I asked the MLO, have you submitted this to automated underwriting to see on your conventional loan if it will review it and accept the fact that it has a disputed account and give you the approval and let you know, yes, I reviewed it. I see you have a disputed account, but we're okay with that. You got the approval eligible. Or if it's going to say, we noted you had a disputed account due to the fact that we can't properly assess the account, we can't issue this approval eligible that you got is not valid, and you got to downgrade your file to manual underwrite, which then will not be possible on the conventional loan. The FHA loan is going to be the opposite. On that one, if it's the dispute is over $1,000, you either can reduce it to under $1,000, or you can downgrade the loan to a manual underwrite at manual underwriting DTI, max 43 on the total debt and not 56.9. That could kill the deal. So remember how always look for disputed accounts and then look at the findings to see how it treated the disputed accounts. Don't be surprised and get the findings and go, disputed accounts, what is this? Oh my God, I didn't know. And you may not have realized that you may have given the pre-approval letter because you're going to get the approval eligible. It's just going to tell you in the findings that it's not valid depending on the situation. And then you don't want to be that MLO that sent the pre-approval letter, didn't read that part of the small print, and now application submitted, appraisals ordered and paid for, inspections ordered and paid for, all these expenses. They even got the moving truck ready. They bought all the stuff, and now you tell them, I'm sorry, but we got an obstacle, and now it may take a couple of weeks because now you got to undispute the account, do a rapid rescore so that automated underwriting picks it up, or go down to manual underwrite if it's FHA. Now, the same with collections and charge-offs. Don't be too dismayed until you run AUS. It's not the first time that I've had a primary residence conventional loan where borrowers had $20,000, $30,000 in charge-offs, but due to the fact that it's a lower LTV loan, I'm not saying 30% LTV either. I think this case I'm thinking of may have been like 70% LTV. And the system says, hey, you got the collections or charge-offs, we don't care. Approval was issued with it. No need to pay off the accounts. You don't know until you run it. So again, that's why all that kind of stuff is determined by AUS, the same as max DTI determined by AUS, the same as asset verification requirements and reserves determined by AUS. It's going to tell you in the last page the reserves required, if you met the target, if you didn't meet the target. If your deal says refer ineligible, usually that's because the ineligible part is usually because you don't have enough assets. So keep an eye on that. Assets, remember, now need to be sourced and seasoned, and give special consideration to gifts and explain to the borrower how those gifts need to be transferred from the donor to the borrower for the specific program, so you can make sure you have the documentation requirements to document the gift. Because just because you got the approved eligible doesn't mean you don't have to dot the I's and cross the T's, right? So what's the source of those large deposits? Look at the bank statements beforehand, because that shouldn't surprise you, right? It's going to tell you X. If the borrower makes, let's say, $10,000 a month income, it may tell you any deposits over 50% of their monthly income need to be sourced. So it's in the findings. Shouldn't surprise you when the underwriter hits you with that condition, because they got it from the findings. Again, that will determine then sourcing and seasoning of funds if needed based on the findings, and then gifts. That's up to you, being a proactive loan consultant and making sure that your borrower, hopefully that gift hasn't been given to them yet in cash, and if it was given in cash, hopefully the donor withdrew the exact amount of the gift that they gave from their bank account. So at least you can reconcile that way, LOE, and cover that base. Another consideration on agency pre-approval: borrower and seller seasoning on title. On borrowers, if it's a cash out refi, and on seller, if they're purchasing a flip. Because if it's an FHA deal, for example, you got the 91-day flip rule. You can't get on contract until the 91st day after the seller has owned the property. And if there is a substantial amount of capital gains on the sale, there may be requirements for additional valuation methods, which usually on an agency loan means second appraisal. Now, if we do manual underwriting, manual underwriting is not applicable for all agency loans, only for applicable for FHA, applicable for VA, definitely not applicable for conventional. If it's manual underwriting, note that the maximum DTI, any asset requirements and credit score requirements, trade line requirements, all that kind of stuff is determined by the matrix. So you just go online, do a quick search for Fannie Mae matrix, Freddie Mac matrix, and you're going to get the basics. FHA matrix, you're going to get the basics that would be for a manual underwrite. And always remember, in agency loans, mortgage insurance, PMI actually, private mortgage insurance, is required above an 80% LTV unless the loan is a HELOC combo loan. Then you got a number of configurations: 80-15-5, 80-10-10, 75-15-10, 70-25, depending on the property type, transaction type. We love these transactions in Florida for our limited review primary occupancy condo loans at a 90% CLTV. We do those depending on the loan amount. Purchase price could be a 75-15, or we may have to go higher on the LTV on the HELOC to meet the minimum HELOC loan amount. I think it's usually going to be at least $50,000. Keep that in mind. So now on our non-QM pre-approval, please note the first two bullet points, because every now and then we get the query from an MLO: oh, I'm getting this error when I'm trying to run DU on a DSCR loan. Okay, that's the first problem, because all, not just DSCR, all non-QM loans are manually underwritten. Full doc, salaried, hourly, full doc, self-employed with tax returns, bank statement, P&L, asset utilization, 1099, and definitely DSCR are all manually underwritten. You pick the program. That's the beautiful thing of non-QM. So when you're structuring your pre-approval and you're looking at the tax returns and you see that you have some like a much lower, let's say 2022 than 2023. So you're like, wow, if I can use 2023, my borrower is going to hit it out of the park. They make $300,000 in 2023, but 2022 business was still recovering from pandemic, so they made only $100,000. Well, you submit to LP or you submit to DU and see if any of the two options give you the one-year finding. LP, if the borrower has been self-employed at least 5 years, that verbiage is built into the findings document. DU, it's just strictly up to the algorithm. If it likes the risk, it'll give you just the one-year findings, and then you don't have to worry about a lower 2022 compared to 2023. You can get the maximum benefit for income using just the 1 year. So again, you would set your file up accordingly with that 1 year income first to hopefully try to get the 1 year, and if not, readjust your file to the 2 year income. But now we're talking about DU. Now here we're talking about non-QM, which is no DU, where you pick the program. So you can't get the 1 year findings in agency, but non-QM, you pick the 1 year tax return option, and now your borrower with only 10% down on that primary deal qualifies for their dream home. So again, that's why non-QM is more, you as the MLO are the filter. You are the automated underwriting search engine, scouring the guidelines and making sure that you find the best option for your borrower. So again, always manually underwritten, AUS not applicable. And this is bullet point number 3. I mean, so important in credibility, trust, and just, sustainability of your career. right? You can only issue the pre-approval letter for this non-QM pre-approval after a thorough review of all docs, all loan parameters is completed and confirmed with the guidelines. That means you need to review all loan parameters and any special circumstances like seasoning on title. Maybe your borrower has only been 3 months, 6 months, 5, whatever it's been. That's one of those special parameters. Disputed accounts is a special parameter. Collections and charge-offs, where you may need to find a program that says if the borrower has, let's say your borrower has $40,000 in charge-offs, but this program says if your borrower has enough reserves left after meeting the down payment and closing cost requirement to cover these charge-offs, then we can offset them with that, and by you adding 5% of the balance of that charge-off, assuming it's a income, a DTI related loan, not DSCR, adding 5% of the balance to the payment and making sure the borrower is still qualified. That's one of the examples. Another may not even say adding 5%, may just say if you have the reserves to cover after meeting the other transaction expenses, you're good. That's the beautiful thing about non-QM, is that every guideline is different. And those successful loan officers are those that uncover every stone, don't leave any opportunities, and don't leave any money on the table. So again, only after a thorough review and reconciliation of the guidelines can you issue that pre-approval letter. So credit, we just discussed some of the parameters, also disputed accounts, right? If there is a disputed account, it may say you got to bring the balance down to $250. If it's a $0 amount disputed account, you may not have to touch it. So it really varies, guideline to guideline. Then you're going to consider a non-QM. What income are we going to go with? We're going to go full doc, or are we going to go alt doc, or are we going to go DSCR, right? That's our no income. That's our non-DTI program. The DSCR is the ratio as opposed to the debt to income ratio, debt to income ratio. It is the debt service coverage ratio. And then we're going to also reconcile any asset parameters. And then again, property, borrower, seller, seasoning on title for the same reasons, right? Flipping on non-QM, it's definitely more important, flipping when the property is being resold, where you could end up with a requirement for a second appraisal, CDAs. Look at the guidelines. Don't get caught off guard on that one. Borrower seasoning on title for cash out refis, right? Using the market value for the LTV as opposed to purchase price plus renovations. That's the key. That's where you as a loan consultant uncovering those hidden gems for the borrowers are going to make more money, going to close more loans, and going to have much more satisfied borrowers. And then on our keep note, very important here, when structuring these deals, that are the DSCR pre-approvals allow borrowers to compete well against cash buyers. All depend on how you set up the pre-approval and how you communicate it to the buyer's agent, and hopefully also to the listing agent to convey how strong your buyer is, the offer, especially the listing agents, because they're very proud of their property, especially when you start letting them know how the property generates a great market rent income analysis and how you already compared that to the PITI, and definitely we're at where we need to be for the loan program. If we're at a 1.0 or 0.75 to 0.99 or under 0.75, which we can do with 25% down. So again, that is key to properly conveying all of the pre-approval benefits to all parties involved. So lastly here, in talking about all parties involved, the pre-approval is not created in a vacuum, right? It's not just the loan officer involved with the pre-approval. You're also talking about borrowers and real estate agents involved in the transaction, and they all have their specific duties where they can add to the transaction, not have it fall apart, so that the pre-approval can actually be a valid pre-approval, and then so everything can proceed smoothly. So borrower duties we're looking at, and again, our pre-approvals are done via a loan application. So we're not talking about the loan application here for the loan necessarily being submitted to underwriting. First, we got to pre-approve the buyer or the borrower, in this case, if it's a refi. So we need a complete loan application. It has to be as thorough as possible. And we definitely need to make sure that they avoid, and you need to convey this message to them before they submit the application, hopefully, is we need to avoid undisclosed debts and undisclosed liabilities because that could affect your DTI big time. We need to avoid undisclosed properties. Again, could affect DTI. Could affect even you qualifying for the loan due to having too many finance properties of a certain type. So again, and we want to avoid undisclosed business losses. If you're going full doc, if it's a DTI loan, those are all things that are going to kill the deal. And I mentioned this because it comes up unfortunately, all too often, where these factors could kill a full doc DTI type loan. By full doc, it could be bank statement. Let's say a DTI type loan, where you're either using tax returns, pay stubs, bank statements, whatever you're using to determine the debt to income. Any of those factors there could kill it, and also could raise alerts to underwriters about, is this fraud, and all of a sudden create a whole slew of additional conditions for you. Borrower needs to provide requested docs on a timely basis, and borrower definitely needs to not open any new credit accounts. And lastly, what are our real estate agent duties? Well, agent needs to ensure borrower submits a competitive offer. Both, they got to do their market analysis, make sure that the offer is on point, not just to try to get the property, but then when they do get it, hopefully we're not too far off target on what the appraisal is going to be. So we're walking a fine line here, right? Then maybe appraisal comes in, and then we can renegotiate if it's a purchase, renegotiate, hopefully. So that's why we're talking about contract negotiation, seller contribution. Try to get some seller contribution if at all possible in their market. That's definitely going to aid the transaction. Real estate agent also needs to monitor for finance contingency and closing date extensions. I don't know, 9 times out of 10, probably I see where we get an extension of the closing date. But what about the one that really affects us? Totally front and center is the financing contingency. Because if they're approved and the buyer then chooses not to close, then that's on the buyer. But if the financing contingency is extended, or let's say the closing date is extended, but the financing contingency is not extended, and then it doesn't close for whatever reason, even though you're still within the closing date extension period, if they did not extend the financing contingency, also, the borrower is in default and could lose their deposit, right? You got to read, most of the contract says that if you don't extend by, this, provide an approval or extend it by the expiration of the financing contingency period, this contract then reverts to a cash deal, and any financing contingency protections are removed, which means borrower could lose their money, their deposit, if the deal does not close. So please make sure that you let our real estate agents know to monitor that and obtain extensions for that as well. Our agents also got to understand that a pre-approval is not a loan commitment. They also ask us sometimes for some funky type of pre-approval for like the funds, where they verify funds availability, pre-approval kind of thing, and then with that they submit no financing contingency offers. That's pretty dangerous. You got to understand that in doing that, putting a lot of pressure on the borrower to lose, and what happens if they don't close? They could lose their deposit, especially, and if it's a substantial deposit, you're going to have a complaint, and that could affect people's licenses. Besides all the other fact that you didn't get to close the deal, a bunch of, a lot of negative things can come out of that. So again, remember all of the pointers we brought up about building credibility and trust and a sustainable MLO career. Make sure you communicate well with all parties of the transaction, agents and borrowers included, And this should all be a happy ending and a closing. So looking forward to helping all of you structure your deals.
All right. Thank you, Jose. Let's see here. I'll check out if we have any questions. Does not look like we do.
Well, then hopefully those MLOs that ask me every now and then, well, I just got the request for a pre-approval. What do I do? Hopefully they're not. Hopefully they're watching so that and they picked up on all the details because I mean this is basic stuff that we're covering here. And if you can't cover these basic points, oh, okay. Look at okay. We got an interesting. I don't know if it's a commentary here or if it's a question, but I love it. Uh, and let me see. I don't know where to start. Jose, if we were not allowed to issue a simple pre-qualification, I will lose that client. Well, I'm not sure what client is being referred to because I can't recall this being brought up, but a simple pre-qualification is worthless. Why do you want it? Now, if you're telling me in the next comment there that you're also a realtor, then I'm really surprised why you would accept a simple pre-qualification. I'm assuming what you mean a simple pre-qualification is where you just talk to somebody and based on information that they represent, you guarantee them the outcome and you put an offer in writing and deposits made on information represented verbally. That's basically hearsay, and that's very dangerous. And that's a borderline fiduciary lack of fiduciary responsibility to your borrower to protect their interests. Right? That's what our license is all about. If you fail in that duty, you could lose your license when they complain to the powers that be, the different agency regulators out there. They're going to come back, analyze the situation. But that's the I guess worst case scenario. But there is no best case scenario here because what it means is that you're not putting out a thorough product. It should not take you more than maximum more than 24 hours, and that's maximum assuming there was a delay in the borrower providing you documentation for you to be able to provide a pre-approval. Right? I mean, you gather docs, they complete an application which could take them 10 minutes. They may not know what they make in income. That's okay. We need just their basic information, employer, all that kind of stuff. You gather docs, you look at the income, right? You put the income in the application. The credit report has already been pulled for you. You have assets, right? Hopefully they gave you 2 months bank statements, or else they may have just put on the application what it was, but you got assets, you got income, you got credit. Run DU. 5 seconds later, 10 seconds later, 50 seconds later, you got either approved eligible or not. I mean, how hard is that? That doesn't take that much longer, and it builds credibility and builds trust. A simple pre-approval letter, a pre-qualification letter, does just the opposite. It could erode trust, erode credibility. If you're a MLO and you're not the realtor and you gave this pre-approval letter and now the realtor says, hey, man, I wrote offers, I did all this work, and now this buyer / your borrower, my buyer, is blowing up my phone because they're about to lose their deposit, and I'm not going to go down alone for this. So I mean, this could go into so many levels. So again, your next comment says listing agents will not even show you the house without a pre-approval. Yes, without a pre-approval. So the borrower gets pre-approved up front in the process. Why would you want to show properties to a buyer that you haven't pre-approved yet? That was one of the first bullet points that we touched. So I'm glad you brought up all of these points, and I hope that you ingest them well, and it should help you double your income and your productivity as a realtor if you're going to get all those loans, right?
All right. I don't see any more actual questions, so I think we'll go ahead and wrap it up. But again, great back to the basics training here. Remember, we do this every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern, where we go through a new loan topics. We'll be back tomorrow with a new topic. We appreciate everybody tuning in, and we'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan